Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. Professor Nathan Mauck and I were having a conversation yesterday, and we both basically pointed out to each other that one of the most often asked questions we're getting right now from investors is what's going to happen after the election. Elections are big deals, and they bring a lot of investor anxiety. However, Nathan and I both obviously agreed to the reality that politicians don't run the economy, and they certainly don't run the individual stocks that investors invest in. Now, policy decisions can have an impact on how good a company is able to grow, or how fast, or how good the economy is going to be, interest rates, etc. But in the long run, you hire companies that have good management so they can navigate the troubled waters. What Nathan and I decided is, let's go ahead and do a video trying to bring to you some of the realities of what really happens in the short run during a political event. Remember, investing is a long game. Politics and election results may have a short-term impact, but in the long run, it's all about the fundamentals of the business you invest in. So let Nathan give you his take on what the elections mean or might mean for investors, both short and long run. Nathan?
One thing that's very top of mind right now in the U.S., at least, is the upcoming election. And a lot of folks wondering, how does this impact the stock market as an investor? What, if anything, should we do to adjust? How might different outcomes of the election impact the stock market? These types of questions tend to come up. We have elections fairly often here in the United States. There's a chance for a change in direction. So I think a normal thing to have questions about. I don't really want to predict what I think is going to happen, either in terms of the outcome of the election or what I think will happen in the market. But rather, this is a good time to really get back to the basics and the fundamentals. And remember that over the long haul, it's going to be fundamentals that drive value. So in the long run, it's really the ability to generate solid earnings, to grow, to manage risk, that's really going to drive a firm's value. And great companies have always in the past navigated a variety of policy environments, right? So we've had basically every permutation of different type of governing arrangement you can imagine. And the great companies have tended to do well in pretty much all environments. So it's, I think, more about competitive advantage, adaptability, having a solid customer base, solving an important problem. These are the types of characteristics are going to be firms that can grow regardless of who controls the government at any particular moment in time. So that's sort of my first point. My second point is also just to point out that timing the market is usually not a great strategy. And as particularly, sometimes people are tempted to maybe get uninvolved in the market around what they think is going to be volatile. So maybe the case is, regardless of what you are hoping for an outcome in the election, you think there's some chance the election is going to result in volatile markets. That's entirely possible, by the way, right? We could see some volatility around the election before and immediately after the election as people kind of make new bets. But in anticipation of that volatility, some people like to think about maybe skipping out on the market or lowering exposure, doing something different than what their long-term strategy is. And I'll show you just one bit of evidence here on the dangers of trying to get around the timing of events. So this is some interesting data that Hartford Funds has up on their website, but it's about, if you miss downs, you miss ups as well, and about 78% of the best days occur during bear markets or during the first 2 months of a bull market. But they also look at what happens if you were to miss the 10 best days over a 30-year period. We'd have a lot lower returns. If you miss the 10 best days, the 20 best days, the 30 best days, that would dramatically alter your investment performance over that period. And again, yes, maybe you would have missed some of those down days, but you also have the ability to miss good days. Usually history has shown us that when we get big jumps, either up or down, they cluster together. So we can certainly think of the pandemic was this case, all right? We had big moves to the down in March of 2020. We also had some big moves up, and coming out of March of 2020, the market really went on a run. And so maybe conventional wisdom would be, hey, it's going to be volatile, I want out of the market. History has not shown that that has been the best strategy. So when we take a look at the S&P on FastGraphs, this gives us another chance to get some historical perspective. And first of all, I just say, things certainly, we can have difficult periods, as we know, and even during this relatively limited period we have here, a lot of years here, but U.S. stock market been around a lot longer than this. There have been some very significant events, world events happen, but yet over 30, 40-year windows, the average annual return of the market has been relatively consistent and relatively strong. And so this is another argument for not really deviating too much from what your normal long-term plan is. But just to highlight a couple things, if you look at SPY here from the start of this data until about September of 2010, so this would be coming out somewhat of the recession, but not sort of fully out of the recession at that. You'll see that the price level on 1/1/2004 was about 111.23, and it was only 111.48 by September of 2010. And so the non-dividend return, the total return annualized ends up being about 2%. That's really driven by the dividends. The capital gains on this would be incredibly small. So this was an extended period where the market on average didn't generate a lot of returns when you look over this period. However, when you look at the full period of this sample, so when we start at the beginning but run it out to present day, we see a different story. So here we see total annual return of nearly 9%, 8.95%. And we can see from the graph key here that we had close to 8% earnings growth over this period. So fundamentals grew, and the return of the market was roughly equal to the earnings growth rate. Return a little bit higher because the current PE on the S&P is a little bit higher than it was at the beginning of this period, so there's been some multiple expansion. But the main point as it relates to elections is we had a lot of elections in here, right? We've got midterms every 2 years, we got presidential elections every 4 years. Yet, fundamentally, over the longer period of time, the market generates returns. U.S. stocks have generated returns because they're able to grow their earnings. And again, this isn't to say certain industries might not be negatively impacted depending on the outcome of an election, or that elections don't have any impact on the market or the economy in any way. The point is, if we take this long-term view, then we can kind of avoid getting too panicky or really deviating from our strategy around whatever major event there might be, including elections. The same is really true for any sort of macro news type environment. We want to learn from it and think about how it might change our opinion of certain stocks and their fundamentals like growth and risk. But we fundamentally don't want to deviate from our strategy too much, knowing that this is really the history of stocks. It's been pretty durable to a variety of world events, national events, political environments, elections, etc. So as I mentioned earlier, great firms are really good at adapting. They're able to generate growth because they provide a good product or service, because they've got a solid customer base, they're innovative, they manage risks, etc. So it's those fundamentals, and it's really the firm fundamentals and the firm valuation that can really drive our analysis more so than some of these macro type of events like elections. And so just one example that's obviously well known, but just checking out Apple's performance over the period here. Obviously incredible return. That's a 35% annualized return, 57,000% return over this full period, just staggering. But again, look, the earnings, the fundamentals grew at about 38%, total return at about 35%. As the fundamentals go, eventually so will the price. Value is really a function of the fundamentals, like earnings, like cash flow, the risk of the earnings, the risk of the cash flow, the growth rate. That's really what drives value in the long run. And so as long as firms are able to continue generating cash and growing the rate at which they can generate cash, we can expect that in the long run, the prices and the value should roughly come together. So here's another example in Broadcom. And again, if we look over this full period, we see a total return of about 37.5% on an earnings growth rate of close to 32%. So again, the fundamentals at Broadcom were solid, and they were able to grow across a variety of policy environments, world events, a great recession, a pandemic, right? That's all included in this time frame. Yet over the long run, they were able to generate this impressive return. Again, I do want to highlight bad things can happen in the market, bad things can happen to firm. There's always risk. There can be downturns, and also prices can sometimes move in a direction other than fundamentals. If we kind of pick this high point in December of 21 and then this low point in October of 22, that was down in overall about 30% for Broadcom during that period. So that's almost a year-long time frame in which the Broadcom stock would have been trading down. So these things can happen. My point is, if we try to anticipate these volatile moments or these key moments and get away from the fundamentals, fundamentally, if you still believed in Broadcom, obviously you would have been better off holding here. Whereas if something truly fundamentally changed in Broadcom, then yes, you might want to, if you were bullish coming into 10, 30, 21, and then something happened to cause this that made you bearish, certainly adjust accordingly. But we want to adjust based on actual information and what's actually going on, rather than getting too speculative about what could happen based on a variety of policy things that may be intended but may not ever come to fruition. So this is, to me, a good example of, again, things can happen to the negative. Certainly, they can be idiosyncratic to a firm, that can be more macro type of events. But again, over longer periods of time, the fundamentals will win out. A related question that folks ask me around an election quite often is what industries or what stocks might be most impacted by an election. And so, for one, regulated industries like banks, different governing structures could result in a different environment for banks. And so those are interesting to look at. Looking at JP Morgan, JP Morgan had a drop in fundamentals during the Great Recession, and it took a while to get back to '07 levels. It took till 2010. Not unlike we kind of saw the S&P took till 2010 just to sort of get back to where it was at the beginning of this time frame. And of course, we had this pandemic period included in here as well, and then kind of another recent drop. But although there are some kind of jagged moves down, overall, reasonably solid growth at around 7.5% here in fundamentals. And if you look at the total return, including dividends here, 9.7%. So solid performing over the long term. So banks have had ups and downs during this window, JP Morgan not excluded, but over the long run, some solid performance in terms of the way the stock has performed and the fundamentals of earnings. Another industry that comes up a lot as being perhaps more reliant than others on elections would be energy stocks. And so here's Exxon Mobil. And one thing I'd point out is there's some volatility in the fundamentals of Exxon. And we see the dip during the Great Recession and the pandemic, and just some other times. Energy stocks are reliant on the price of the underlying goods that they sell and that they produce. And some of this might certainly be related to various policies, but also the fundamentals of energy in some way don't change hugely. We tend to have more energy demands over time. It tends to be increasing, and the providers of energy tend to provide goods and services that are needed. The mix of how we get that maybe has changed or maybe could change, etc. But still, even with this kind of volatility in earnings over a period of time, not as high as the S&P return, but still about a 7% total return for Exxon Mobil here. Pays a little bit of a dividend. But again, just to give some historical reference of how do these stocks and these industries that might be impacted by elections, how do they look? And again, this is another one that, yeah, there is some volatility here, but overall, fairly solid return over a long window. And maybe one more industry that comes up as it relates to the impact of elections and policy is healthcare. So I've got UnitedHealth up here. First of all, just looking at the fundamentals, the green of UnitedHealth, very strong, growing about 14.6% over this time frame. If we look at the total return, that's close to 16% over this period. And again, includes a Great Recession, that includes a pandemic, includes multiple elections. So UnitedHealth has really been able to navigate any policy environment they have seen. And to the extent that you are a believer in their ability to continue that, could be interesting to look at. One thing I'd point out with UnitedHealth is, regardless of policy outcomes, I think fundamentals are critical, but so is valuation. And so looking at the price you could pay right now, still getting a good buy, focusing on fundamentals and getting a good buy, That's the best protection against bad things that can happen in the market. And bad things will happen in the market, as we know. History teaches us that. So if we look at where UnitedHealth is now, it's trading a bit above its historical multiple. And if we run the forecasting calculators out and say, hey, what if they hit their expected returns, but their multiple comes back down to something maybe better suited to their growth rate, there might be some downside there. However, if they hold in at around the multiple they're at currently, there's some upside. So those are the types of decisions you can make. Fast Graphs gives you the tools to be able to think with and to make those decisions. Just like this, you take all the information you have about United Health and do your own due diligence. But then when you want to see a kind of an if this is true, what kind of return am I looking at? This forecasting calculator is really handy and can help make decisions and help us still focus on value even during times of policy uncertainty. So hopefully it's useful to get some kind of refreshers around the election, which is, yes, elections can have impacts on the market and maybe disproportionate impacts on certain industries depending on the outcome. But as investors, it's also a time to really think about our long-term strategy and stick to the process that we usually use and to focus on the fundamentals, focus on valuation, and managing our risks through due diligence and homework. And yeah, updating information as things change in the environment. Certainly we update our information, but overreacting or trying to avoid volatile periods has historically not worked out real well overall.
Thank you, Nathan. That was excellent. A couple of things that Nathan pointed out was that, regardless of what political party was in control, the stock market has really been ascending historically over long periods of time. Now, he pointed out in fast graphs, you can only see the last 20 years or so. So let's go ahead and take a look at fast graphs real quick just to summarize what Nathan talked about. Here we have the S&P 500 going back all the way to the beginning of 2004. Okay, and if I shorten this time frame for the last 10 years, which includes some forecasting years, here we have the Trump administration, and then here we have the Biden administration so far. And of course, we don't have the year end yet. We're coming into the election cycle. And notice that there's volatility in markets, but the election itself has really had very little to do with how the market reacted. There was very little reaction when Donald Trump won. There was very little immediate reaction when Joe Biden won. But now valuations of the market and the fundamentals, the orange line of the market, had a lot more to do with things than who was in political power at the time. So again, I want to thank Nathan for his great video. And I do want to point out and basically say to you that it's a market of stocks, not a stock market. Always remember that. Investing is a long game. And politics may have a short-term impact, but in the long run, it's about how good the businesses perform in the market. And you as the consumer are probably a bigger determinant of that than the government or the government policies, even though they can have short-term effects. Thanks for watching. If you liked the video, subscribe to our channel, give us a like, and take a look at subscribing to Fast Graphs because they can keep you grounded, especially during troubled waters. Thanks for watching.